For tuning into Talking Point. I'm your host, Niraj Shah. Well, I think the common talking point across the world currently seems to be the re-emergence of the argument of what would happen to markets, or can something happen to markets because of the stress around the COVID-19 cases, even as the vaccine is around the corner or in play already. Well, that's the principal one. And then, of course, moving around that is the kind of staggering run that we're having across sectors, most importantly, uh, commodities, which have really had a merry run. And then, of course, the standard plays around pharma and information technology. So, lots to talk about with our guest today. Pankaj Murarka, CEO of Renaissance Investment Managers, joins us right now on the show with his thoughts on some of these and maybe some more as well. Pankaj, so good having you. Thanks much for joining in. Hope all is safe.
Yeah, Neeraj, thank you. All very much safe. I hope you are safe as
All
well.
good, touch wood. Yeah, thanks so much. So, Pankaj, tell me the one key question, and Pankaj Murarka is doing the interview standing, so health be, wealth be, let's put it that way. Pankaj, tell us, what's your sense around this pickle? I mean, we're reading articles on the website about how the NHS in the UK is overburdened, and the stress out there is clearly visible on the healthcare system. It's probably there in rest of Europe as well. And while US has started giving shots, it's certainly not out of the woods when it comes to the cases. Can that put a cloud over the optimism around the central bank liquidity for equity market?
Well, I think the good thing, Neeraj, is we've started the year 2021 with the whole vaccination process. We have a vaccine in hand, probably the fastest vaccine the world has ever seen in terms of development. So science has really come to the help of humanity and mankind across the world. So if I put it in context, I think 2020 was about lockdowns and COVID fatalities or mortalities. 2021 will be about unlocking and vaccinations. Hopefully, from whatever reports I've seen, the estimates are that probably by the end of this calendar year, we'll have 60% of the world population will get vaccinated. And that's a good thing for the global economy and for the society as a whole. So I would not be too concerned about the short near-term lockdowns which some of the Western world economies are seeing, including UK, because I think vaccination is happening at an accelerated pace. As far as the liquidity support from the Fed is concerned, see, the fact is all of us know that the liquidity support is unprecedented and historic. At some point of time, it will come to an end. It cannot continue for ever. But I think at least I don't see that stopping at least during the course of 2021, because I think economies will normalize by the end of this calendar year. And I think the Fed will be supportive of growth and recovery. So I don't see them preemptively withdrawing support. And Mind you, meaning there are some concerns globally on double dip recession going into the this year. I'm not in the camp who believes into double dip recession. We are, in fact, on the contrary of the view that we'll see a very sharp growth recovery in India and globally across the world.
Yeah, I mean, so no, actually, let me rephrase my question. Maybe people might be worried about the recession. If anything, we look very strongly poised to give good economic growth. But that is for the latter half of the year, say quarter two onwards. My worry was about the very near term, because we are at elevated levels and because the virus is showing new signs of rampaging in a new strain or what have you. Can there be an issue? Can there be a drawdown or a drop down which could be sharp in nature? And I know that you would say that, a drop down is never ruled out, but I'm just trying to figure out how high is the probability of that to your mind.
To my mind, a correction looks quite a possible event that could actually play out sometime, probably later Feb or March kind of a thing, because obviously, as you said, the rise in the markets has been parabolic. If you go back from the March lows, yeah, in India, the indices are up something like over 82%. And I think the same is the case with US markets, and most of the other risk assets globally have rallied very strongly. So there'll be a bout of profit taking where people would want to take money off the table, because obviously returns that markets have delivered or risk assets have delivered over the last 1 year has been extraordinary. No one thought in last March that we will make the kind of returns we've actually made over the last 11 months or so. So I think a round of profit taking will happen, but I think to my mind, in the longer construct, when we think about Indian markets, that would be more a pullback or a correction in a bull market, because I firmly believe that we've started a new bull market in India from the March lows. and this cycle will be an enduring one.
Okay. So let's talk about having established that, and it's a bit of an imponderable, right, as to what the markets will do. But let's try and talk about what's working, what's not. We are on the cusp of the earnings season. Within your portfolio companies and therefore the themes that you might be investing in, where do you expect the sharpest or the strongest earnings growth stroke commentary? A lot of sectors will do well. My question is, where do you believe we will see the strongest delta?
Well, clearly, IT will stand out because probably this quarter will be one of the strongest or the best quarter, third quarter the IT companies would have in the last decade. Because partly one, because there's a low base of the last year December quarter, and they have seen accelerated deal signings in the fourth quarter of last year and the first quarter of this year, and all of that will start trickling down into revenues for most of these companies. So I think IT is going to have a very strong quarter, and probably we're going to start our earnings season probably tomorrow with TCS reporting its numbers. So I think IT clearly stands out of the pack. Apart from that, otherwise, healthcare companies should continue to do well. And what is more important is from going into this quarter's earnings is investors now having digested the lockdown and the impact of the lockdown in the first quarter, where we've seen substantial impact on earnings. People are looking at a recovery in earnings from the lows of the first quarter and how earnings would look at on a Y-on-Y basis as compared to the last year. And clearly, the recovery in earnings or the demand resurgence in most pockets of the economy is surprising on the upside because we've seen very strong recovery in, let's say, passenger vehicles and most of the auto segments as well. If you look at passenger vehicles, meaning some of the leading players are having a wait list of as high as 6 weeks or 8 weeks for some of their models, which is clearly unprecedented. So all I'm saying is that we are seeing very strong signs of resurgence of demand in a lot of pockets in the economy. All of that might not reflect in earnings this quarter itself, but markets are looking forward to over the next few quarters when all of this demand starts reflecting into earnings over a period of time.
Okay. The question is, do you reckon that so we saw that Novira report which spoke about the deal wins, right? And TCS and Infosys seem to be at the forefront. But when I read reports across, Pankaj, and I'm not asking you to give me a recommendation, by the way, I'm just telling you that when I read reports across, a lot of people are finding favor not just with TCS and Infi, but also with HCL Tech and Tech Mahindra. HCL Tech for the reasons of valuations being a lot more reasonable compared to the other two, and the growth rates being very strong, and for Tech Mahindra for the whole 5G opportunity. Um, so are you only looking at the top tier 2, 3 names, or are you even looking at mid cap IT because there the valuations in some cases are even higher than large cap IT, but maybe the growth rates are strong?
No, we have ownership in some of the mid-cap IT as well, and I think there are certain companies which we like, and I think the investment argument there is extremely compelling because I think probably after a gap of almost 8 or 9 years, what's happening with IT is needed because this pandemic we have seen acceleration in adoption of digitization by Fortune 500 companies. Every global company wants to accelerate and digitize their business as soon as they can, and which is effectively reflected into a strong demand resurgence for services from these companies in terms of their digital capabilities, because every global Fortune 500 companies want to make their business digitally enabled and they want to enhance their digital capabilities. And Indian companies, being a significant having a significant market share in IT services, have a significant role to play in helping their client acquire these digital capabilities. So I think the kind of flow that we are seeing in terms of deal signings and the work is clearly tremendous, and we are seeing a large resurgence in demand for these IT companies for their services after a gap of almost 8, 9 years. So I think this is going to be a wave which is going to be much longer, and the smaller companies will also benefit out of it.
Hmm. Actually, speaking of IT, Pankaj, I remember our last conversation wherein you mentioned that the CRAMS business is at a space where IT was 20 years ago. The market certainly seems to have taken notice of that. Syngene is on a roll. That's probably the only one which is in that space. I wonder if valuations deter you. This is for the benefit of people who maybe missed the last conversation and looking at one right now. Do valuations deter you, or do you believe that the growth opportunity is so long and so prolonged that might be worthwhile buying an expensive name as well, simply because of the opportunities that lie ahead?
Yeah, one lesson I've learned painfully in my career, Neeraj, is when you're buying structural growth stories where the growth could be enduring for a long period of time, let's say 5, 10, 15 years, don't bother about valuations. Because they'll otherwise you'll end up selling far too early into the cycle. Meaning, just go back to 99 2000 during the time of the dot-com bubble. All the IT services company, including the Infosys and a lot of other peers, that point of time used to trade at multiples which range between 100 to 200, and those companies were growing at that point of time at a phenomenal rate of 60-70%. So as growth accelerates, valuations will expand. I don't think so. If one is convinced about the endurance of growth over a slightly more longer term, I don't think so. Investors should be too concerned about valuations in the short term or medium term, and they should just stick with those businesses.
Hmm. Okay. The other bit is, Pankaj, we are seeing the re-emergence of auto numbers, right? I mean, I've seen 3, 4 brokerage notes talking about how they like an Ashok Leyland or an Escorts, etc., etc. The classic truck sales numbers that have come out have led to Bharat Forge and RK Forgings, etc., doing well. Do you believe the cycle seems to be turning for the global auto companies at large, and are they worthwhile looking at, or would you give them a skip?
No, I'm a big believer in cyclicals, including autos, because I think we are seeing a strong demand resurgence for all these sectors or segments of the economy. Just think about it. Though it's partially because of the low base, but despite that, next year India will have a nominal GDP growth of 15-16%. Obviously, as I said, part of it is because of the low base of this year, but yet that's very significant. And probably our view is that if you look at the Indian economy from a slightly more medium-term perspective, we think over the next 3 years by FY24, as some of these recent government initiatives, including the PLIs, start showing traction, probably India can hit a double-digit growth. So in context of that, we are very positive on all the cyclical sectors which are related to the core of the Indian economy, and be it autos, when it comes to autos, be it passenger vehicles or commercial vehicles, are at the very core of it. The CV industry has declined by something like 60% from its peak in 2015. And the volume this year are back to where they were in 2003 in India. So I think now when we get a demand resurgence, it's going to be a very sharp bounce back, and I think the industry will have a very strong demand uptick for the next 3 years.
Yeah. So, Pankaj, let me first ask you a couple of other questions on sectors, and then I want to ask a broad-based question. Since everything is looking good, how is it that you are going about choosing where to place a higher bet versus what to avoid, even if it is looking good? But I'll get to that question at the end. First, I want to ask you about the commodity space because that's the other one that is looking so strong, right? I mean, every single report and some very smart sell side analysts who've tracked metals for really long time and have gotten the calls right are saying that this is the time to actually bet even more. Even though the stocks have run up, it's time to bet even afresh on the metal space, particularly the steel companies, but even some of the others. Now, what's your sense? I mean, if everything is doing well, surely we're in the midst of a commodity upcycle. Does it lead you to bet on these cyclicals as well?
So, Neeraj, there are two or three factors which have led to this strong resurgence in demand for commodities. One, clearly, because of the lockdown, there have been supply side issues in a lot of countries which have not been able to ramp up their supplies. And at the same time, China has used the same, their model of what they did in the 2008 crisis, where whenever there's a sharp dip or collapse in commodity prices, the Chinese state government agencies go and they buy very aggressively, and they stock or restock their build up their inventories, because they know that in a lot of these commodities China is the biggest consumer, and probably they see that as an opportunity to buy a lot of these commodities at much lower prices and use it over a period of time. So I think that has led to a sharp resurgence in demand, and there's been a supply side issues which have led to this strong demand price recovery in commodities. If the demand does sustain, which I think is likely, I think we could be in for a strong commodity cycle, but it's slightly early to call out for that. And that's primarily because if you go back and see in the last 10 years, the world has not created new capacity for commodities. If at all anything, China has closed capacities across a lot of these commodities, be it chemicals, be it metals. So the effective productive capacity in world, let's say for something like a copper today, is where it was exactly in 2013. For the last 7-8 years, the world has not added incremental copper production capacity. Now, if you get demand recovery in copper, then probably we could reach a situation where the world could run out of supply and you can see huge sharp spike in prices. Also, once you start process of creating capacities in commodity, it's a slightly long drawn process. It takes at least 3 to 4 years to bring up capacities. You cannot bring commodity production capacities overnight. So I think if this demand sustains, which I think there's a very high probability, then we could be in for a commodity cycle.
Uh, and viewers, that chart is very interesting. The chart that we just pulled up, if I can just reflect on it for a minute. If you look at number 3 and number four is APL Apollo Tubes, which is, by the way, the best performing stock in this index for the year gone by. For 2020, APL Apollo Tubes is the best performing stock. And yet, if you look at the last 3 months, Tata Steel has actually done double or nearly double of the gains that what APL Apollo Tubes has had, which is just showing the kind of surge that some of these metal companies have had, and particularly the steel companies have had in the last 3 months. It's just been quite spectacular. Do you think the ancillaries would benefit as well, Pankaj? A bunch of commodity supplying companies, smaller steel and iron companies, etc. I mean, people are now starting to move to the second rung ones. Would you believe that's a smart strategy, or despite the gains, stick to the leaders?
So from our philosophy point of view, we largely stick to the leaders or the integrated players. But given where the commodity prices are, let's say steel, standalone steel makers have turned profitable. They were not making money for almost last 2 years because of the sharp erosion in margins between the steel prices and the raw material prices. But now at these prices, the standalone mills are making supernormal profits. So I think we'll see supply coming back from these standalone players. And obviously, and I think this is very key to a revival of the investment cycle in India, because if commodity companies start making strong cash flows and if there's a recovery in demand, then I think they'll go back and invest into creating more capacities or new capacities, and which could be very important and crucial for reviving India's investment cycle, which has been missing for the last almost 10 years.
Hmm. Okay. Um, Pankaj, now the key question, right? Everything is looking so good from a prospects perspective. Valuations on most things are stretched on a current year basis. Maybe 1 year forward, they might be looking okay. So, how do you, as an asset manager, decide that let me let go of this, even though it is looking like an opportunity, because something else might be looking better? And what if the long-term prospects of some businesses are very strong, but the short-term prospects of some of the others are so strong that the price movement might be faster? How do you kind of then pick and choose what is it that you're letting go in favor of what is it that you're buying?
Sure. Yeah. So, Neeraj, one, we've been pretty inactive for almost, the last 6 months in the markets, because we were fully invested early into this rally, and then the way the markets have rallied, we didn't have to do much. And usually, we don't, change our portfolios so often in that sense. Having said that, I must confess that, meaning the first few days of the new year, we did sit down with our portfolios, trying to have a relook at it. And I must admit that there are a few pockets of markets where there's a froth, if not an absolute bubble, in terms of valuations and where prices are in relation to their fundamentals. Prices are significantly ahead in a lot of these cases than what near-term fundamentals would justify. Then from our perspective, really boils down to more stock-specific approach. There have been some cases where we've actually taken some money off the table now at this point of time. Whereas there are cases in companies where we have a very positive or constructive outlook on their business from a slightly more longer term perspective, and we are just sticking with them. We completely understand the fact that the stock prices can correct and we can have a drawdowns in a portfolio, but we are happy to digest that volatility and just stick with them, because our view on those companies is far more strategic and far more long term, where we're thinking about those companies more in terms of 5 years and 10 years, and not in terms of the next 6 months or 1 year. So willing to take that, digest or ride that volatility and just stay put with them for a longer period of time. So to summarize this, I clearly think there's a high probability of pullback in markets some point of time in the first quarter, Jan-March quarter. And I think we are just positioning our portfolio a bit for that kind of a correction by taking something like 10% money off the table and creating 10% or that sort of a cash in our portfolios.
Sorry, am I getting it correct? You are saying that at the current point of time, you're looking to build up some cash, maybe around 5-10% of your portfolio?
Yeah, that's right, Neeraj. Despite our bullish or constructive view on markets and the economy from a slightly more medium-term perspective, I must admit that while we were fully invested, we didn't anticipate or expect the kind of returns that we have made over the last 9 months in the markets. And clearly, when we look at companies and sectors more closely, we think that in a lot of these cases, stock prices are significantly ahead of their near-term fundamentals or what the near-term fundamentals would justify. And
In,
as a
in,
result,
in what areas would these be, Pankaj? I mean, or what sectors would these be?
so internet is one sector which we have been invested in for a long period of time, and valuation there have completely blown through the roof. We didn't expect that. That's though it's a very welcome and handsome New Year gift for us and all our investors. But we don't mind taking some money off the table. As they always say, you don't get killed for taking some profits from market. So this point of time where returns have far exceeded our expectations, and as you rightly said, valuations having said that we are constructive on markets, valuations are rich, and if at all anything, if you put it in the context of where we were pre-COVID to where we are today, one thing that has clearly changed is if valuations were rich pre-COVID, they're even more richer today. So I think we are and will continue to remain in an environment where growth assets will be very richly valued. And as a result, they will be susceptible to sharp pullbacks, and which is why, as I said, we've taken some money off the table.
Okay, last couple of questions, Pankaj. I'm extending this a bit because of the answer that you gave. Since you mentioned internet businesses, right? So I was just looking at a deal that happened yesterday for Udaan, right? I mean, they got in the money, raised about $280 million, if I'm not wrong. And somebody who tracks these businesses closely, I don't know if you look at IndiaMART, Intermesh, and Udaan, etc., but somebody who tracks this told me that if you just look at the valuations at which Udaan has raised the money, IndiaMART, Intermesh seems to be very well placed simply because of the 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 valuation to sales. If you just look at the value to the market cap or whatever, EV to sales, IndiaMART, Intermesh is not as expensive as what Udaan is. And if people are willing to bet on Udaan at these valuations, why shouldn't IndiaMART, Intermesh be any different? Any thoughts?
So Neeraj, I have a lot of gray hairs, and I've lost my hairs in the last 24 years of my career. And what you said just reminds me of what I experienced in the technology or the dot-com bubble in '99. Yeah, that any bubble, the starting point of the argument of the starting point of any bubble is a very fundamental sound valuation argument. And then we move on to the relative valuation argument. You go back to 1999, 2000, the valuations were all about value per click and stuff like that, as to how many visitors you get on your site, and people started valuing that. And we created one of the biggest bubble for over 2 decades in 2000. So I think we've got to a situation where we are extending or overextending things in terms of trying to compare relative valuations of one versus the other. And I must say that that's a global phenomenon. You look at US, and a lot of these companies which have been loss making are valued at crazily. Meaning there's a big debate on now Tesla is a S&P 500 company. Yeah, the value of every car they sold is something like $1.35 million versus every car that GM sells is about valued at $9,000. So I think there is very high value that is placed on these growth companies, on the future growth potential, and there will be disappointments in this journey because not all of these companies will be able to deliver the expected growth. So valuations are stretched, or I must say they are getting euphoric. But yet, from an Indian context, I think if you get the winners right, if your company actually delivers the growth, valuations will take care of itself despite being expensive.
Okay. Pankaj, last question. Have you tried to look at or study cryptocurrency?
Yeah, so we spent last year scratching our head and spending time on it, trying to understand it much closer. I think if you really ask me, from my point of view, I've become a believer into it, especially Bitcoins. I think given the way central banks have behaved and the kind of liquidity they've unleashed, the world longer term would need an alternate to central bank sponsored or central bank manufactured currencies. And some of these credible cryptocurrencies are an alternate to gold. And as long as central banks keep printing money the way they are, I think cryptocurrencies have a play.
So Bitcoin has a play, or or is it too soon for you to pass a judgment on that?
No, I think it is arrived as an asset class. So I think if you really ask me, from our perspective, though in India it's difficult to participate into it, and our clients don't have that kind of a risk appetite. But from a global investor's perspective, someone who's not done it, he's already late because it's arrived as an asset class.
Okay, Pankaj, we'll leave it at that. Thanks so much for taking the time out and speaking to us today. Lovely chatting. Stay safe.
Thank you, Neeraj. Thanks a lot. Take care and stay safe.
Thank you. And viewers, thanks for tuning in to this edition of The Talking Point.